Interest rates are about to rise. Welcome to Momentum Property Education. My name is Daniel Wood, and today we're going to be looking at interest rates as a cause from inflation. So please make sure you subscribe to our channel so you don't miss any updates on what's happening in the economy, how you can build your property portfolio as quickly as possible, and of course interviews with top experts from all over the world. Also, please like the video, because if you do, we will, as a thank you, plant a tree in response. We got a partnership with Eden Reforestation Project, and every time we get a like on this or any of our YouTube videos, we plant a tree as response. So thank you so much for being a part of that. Now, are interest rates about to rise? Well, inflation continues to rise. Inflation in October in the UK was 4.2%. In the US, we're looking at over 6% inflation. This is not good. This is really not good. It's supposed to be 2% is the target, and right now we're talking double and triple that. Now, there are some reasons why that is good, there are reasons why that is bad, and there are reasons why this is happening. So let's cover all of this and then look at what are the central banks going to do as a result. So first things first, why is this happening? Well, this spring we did a lot of videos here on the channel where we talked about that the excessive printing of money that was doing to kind of prop up the economy during lockdown was going to come back as inflation. Well, it took a little longer than we expected, but yes, inflation is now here. So that is, the way inflation works. Basically, inflation means that the prices of things goes up, right? That is also means the reverse, that the value of money is going down. So the more money you have, if you have as many things, right? You have as many things that are made, but you have more money. Well, then that money gets split over those things, right? It's supply and demand. A bigger supply of money versus a same or smaller supply of things, and the price of those things will go up, meaning the value goes down. During lockdown, we've had issues with the supply chain. We've had issues with actually getting things, right? Getting stuff. And we've had more and more money being printed, which means that, yes, the value of money is coming down and prices going up. Now, why is this a bad thing? Well, the reason why this is bad, it means that all your savings have in the last year in the UK lost 4% of its value. In the US, it's lost 6% of its value. So if you had anything that's valued in dollars, if you had dollars in a bank account, or if you have assets in dollars, well, they have lost their value by 4 to 6%. Right? So in the UK 4, in the US 6. So that is the problem, is that people's savings are getting wiped out. Now, of course, if they've invested in assets that have grown faster, that compensates a little bit. But the challenge is most people's salaries haven't been raised by 4% in the UK or 6% in the US in the last year, right? Which means now if you were making $10,000 a year, or let's say $50,000 a year before, and you went out, you would buy, you'd pay your rent or pay your mortgage, you'd buy the things you need, you put gas in your car. Well, now you actually have in the US 6% less money to do so with, and in the UK 4%, or actually the prices of those things have gone up. Meaning your budget, your personal budget has been tightened significantly. And considering the fact that most people are living on the edge, just because that's how we humans work, right? The more money we make, the more we spend, and we keep living on that edge. Well, now we've had a pullback. Your value of your money is going down. And that is a huge, huge problem. So this is why it's a bad thing, all right? Why could it be a good thing though? Well, it goes in the reverse as well. Now, if you have debt, so if you have a mortgage, for example, or if you have a property and an investment property and you have a mortgage, then the value of that mortgage has gone down by 4% in the UK in the last year and 6% in the last year in the US. So now your mortgage is actually worth less than it was before. And assets like property generally go up by at least inflation. And we've seen that in the UK. We're having highest house prices in history, highest average house price. So the price of the houses have gone up while the mortgage is the same, right? Which means you've built equity. So as investors, inflation is actually a good thing. I interviewed Simon Zutshi here on the Momentum Property Education channel a few months ago, and we talked about this, about how inflation affects. So you can actually go to the playlist, the Momentum Investing Podcast playlist here on YouTube, and you can go back and you can check that interview with Simon Zutshi. And we talked about inflation because we knew it was coming, right? We were talking about what was going to come. And this was the big pro, is that your assets that are growing and have a fixed mortgage, well, your asset has grown, but your mortgage is the same. So you've built equity in there. So that is the positive. Now, what are the central banks going to do? What choice do they have? Well, for them, they can't let inflation keep running like this because it's going to hurt the individual, right? They're not going to be, companies won't be raising salaries by 6, 7, 10% per year. That's just not going to happen. But prices of items is going up at that pace, which means we're having a huge issue. We're not at hyperinflation. Hyperinflation is one of those things when you have such extreme inflation that, money is losing value. So people have to run to the store and just as soon as they get money, buy things because they know that next month that money is worth less. It's not that bad yet. But if it keeps growing like this, it will be. And so they need to curb this. They need to stop this growth in the economy, in the inflation. And the way to do that, remember what we said, the cause of inflation is you got more money, we have the same demand for items, and you have a lack of items, right? So that means that people are willing to pay more. And what happens then is if they can make money more expensive, right? So what they do is they raise the interest rates. That means your mortgage gets more expensive. That means it's more expensive to borrow money on like short-term credit loans and credit cards, which means you don't want to buy as many things because you can't afford it, right? If you all of a sudden, say you always, every single day you buy a coffee at a Starbucks or an espresso house on the way to work. Well, now that might cost you, let's say that cost you €3 a day or £3 a day, right? Your coffee. That's, that over a month, that will be about let's say 90 pounds a month. All right. Now, if they raise your interest rate on your mortgage and your mortgage goes up by 90 pounds a month, that means you have 90 pounds less to spend. And one of the things you might take away is your buying coffee. That will create a smaller demand for things, right? The demand for things goes down, which means the price increase gets curbed because the supply and demand side change. And so they're going to be forced to do this. And they look at it already before Christmas, they're probably going to raise the interest rates in the UK, which means right now we want to get fixed mortgages. But of course, the banks know this too, so they will probably work that into the fixed mortgage cost. But it's important to understand we're going to have raising rates come very soon. Probably before Christmas, maybe after Christmas, we'll see. But it is coming, and it's important that you're ready for it. All right, thank you so much for joining us here today. I'll see you soon.